Gotcha. So, in our current climate right now, right, we've had some, the coronavirus, the scare. I think Dow Jones hit its lowest point in 1947. I can't remember the exact year it was.
Drop,
the single
biggest
drop since 1984. So I exaggerated a little bit right there. But how do your returns compare to the stock market? And if I'm an investor, kind of coming to you, and I hear your pitch and I want to get in. How would you compare yourself to the performance of the market, right?
It's a great question because at the end of the day, anybody who's raising capital, you have to understand markets and you have to understand what options are out there for individuals who are investing, period. Because your performance is going to be evaluated, or your offering is going to be evaluated against everything else. So if somebody's already invested in the market and they want a little bit more diverse exposure, it's like, okay, I've got enough in equities and bonds. Maybe I'll do something that is more stabilized or development play, alternative assets, real estate, bullion, things like that. Generally speaking, what we always shoot for the market, if you take the S&P 500, which is kind of the index that everybody evaluates their performance against. S&P 500 on average since its inception in the 20s. I believe it's the 20s. If I misspeak, I apologize. Has been at 8%.
Yep.
So you may have a year like you had last year in 2019, where the equities in the stock market went crazy, and you got like a 27, 28% return. Right. Fantastic. But now you look at what's happened so far in Q1 here in 2019, and the bottom has just fallen out of it. So you take, who knows where the rest of 2020 will land, but then when you average those two things together, if you end up with let's say you end up with a 2% return this year and 27% last year, well, you're going to average out over those 2 years around, 13%.
But year three might bring you right back down to that 8% return.
Right, exactly, exactly. So, it's always based off an average. So it's all in an alternative investment space, such as real estate on a development side, because there's a little bit more exposure to risk when there's no cash flow that's coming in. We generally try to shoot anywhere between a 20 and 30% pro forma annualized return.
Which is terrific.
Which is fantastic.
Right.
On a cash flow basis, depending on the asset quality and the location and your strategy with the asset itself, you may land somewhere in that, if it's a B class, somewhere in that 15 to 20% range on a year-over-year basis. Whereas, if you're buying and building A-class kind of asset stuff, brand new, if we took this building here and decided to rent it and then sell it in 5 years, you might be looking more in the vicinity of a 10 to 12% type of return. So the class of asset has a direct correlation in your acquisition price, and the performance of it has a direct correlation as to kind of the return that you'll end up being able to provide investor partners. But
yes.